Let's talk about some other financials as well today, the bigger ones. Bank of America, Morgan Stanley, adding to the upbeat trend in investment banking specifically. Both banks seeing big gains in that business. A similar tone from peers JP Morgan, Citi, and Wells Fargo. Yet with Fed rate cut expectations still unfolding, there are challenges ahead peeking through for big banks. CFRA Director of Equity Research, Ken Leon, is joining us now to discuss. Ken, normally we've been starting sort of big picture here, but I want to zoom right in on Bank of America because you downgraded that stock to a sell today in the wake of these earnings. Even though the shares have been doing pretty well, their highest, in fact, in about 2 years. They gave a forecast for net interest income that was above some estimates. What didn't you like in these B of A results?
Yeah, it's great to be with you. So I think Bank of America's, it's a 15-year high. So that's pretty good. Rates, outlook, and the economy are good. So all the financial stocks, large bank stocks are doing great. But for Bank of America, the performance in the second quarter was like the first quarter. We had flat, no growth in loans, no growth in deposits, no growth in credit card income, which is significant. And we saw a decline in net interest income. So a lot of the storyline on the call, which I think analysts kind of liked, was that even though you had negative net interest income, which is 54% of your total revenue, it's going to get better in the second half of this year because in the second quarter, deposits declined for consumers who had to pay taxes. So it's kind of weird to see the stock up, but I think that's more to the macro call on financials and banks. I thought Bank of America underperformed compared to JP Morgan, Goldman Sachs, or Morgan Stanley today.
And how could you do move to a sell there, Ken. When you were talking to your clients, how could you be wrong, Ken? What are the upside risks to that call?
Well, there's always respect. We're all students of the market. So what we do, of course, on any recommendation is make a judgment call based on our insights, our views of the fundamentals, and of course, our experience. So, CFRA is the largest independent research firm in the world, and we make independent calls, and that speaks to your question.
You mentioned Morgan Stanley and its numbers today. Saw some strength in investment banking. That's what we saw for many of these banks, particularly in the capital markets business as well. How sustainable do you think deal volumes are going to be going into the second half of the year, particularly with the election coming up?
Sure, it's a great question. And we hit the trough for investment banking fees last year, probably in July. We're still at just the beginning of a rebound. But saying that, the first half of this year had record results for debt underwriting, but equity underwriting and IPOs are still in really the early innings of recovery. And keep in mind, there's two major sources for deals. One is obviously corporates, but the one that has not been participating as it tries to figure out valuation with rates is financial sponsors. That's the alt industry that I cover, which includes companies like Blackstone, KKR, Apollo, and many others. So that's $1.2 trillion in their investment cycle that has to be monetized. Otherwise, their wealthy limited partners around the world from the Mideast or Singapore, wherever, aren't going to go into new funds. So that is a major opportunity for Morgan Stanley, Goldman Sachs, and each of these firms also are participating in the alt investments as well.
Ken, I'm curious too, it is an election year, politics are front and center. Are you getting questions from clients about how you think this election could play out and what it could mean for the sector you cover?
Yeah, so, my good colleague for many years, Sam Stovall, our equity strategist, is all over this, along we have four great research teams. One is Washington Analysis. They have actually reversed and see a higher probability of Trump getting elected, but things can change. Generally, in answering this question, my view is watch the Fed and watch Jay Powell. Jay Powell, as you all know, was interviewed at the Economics Club and was leaning to a Fed rate cut in September, maybe another one later this year. I think that matters more than us playing the hand of who's going to be in the White House and who controls Congress. But of course, Sam Stovall has all that data going back to 1940.
Let's get your view on that rate cut then, when it ever does happen. On balance,
Sure.
is it better for the banks when the Fed begins to cut rates?
I love the question because the answer is it depends. So in research that we publish, I have a chart I've used for years that looks at the mechanics of how rates impacts net interest income, which we did speak about, or loan volume. So the direct answer is so long as we have a stable or strong U.S. economy in particular, then if rates are coming down 50 basis points, but the volume book of loans grows, doesn't decline, then it's kind of, to me, going to a rate cut regime is neutral. It's not negative.
But I guess that latter part is the important part. Is the loan book declining, right? What are we seeing among consumers in terms of that loan demand right now?
Sure. So we look at all the loan components quarterly for every bank, and then also look at delinquencies and provisions for loan losses. And so far, to my point, I underscore a strong U.S. economy. We are seeing increases in transaction volume and loan activity. No, it's mostly the upper income or the baby boomers that are driving this economy, that are mostly have portfolios in the market. Those who are suffering out there in the U.S. are lower income or middle class, where it's hard to pay their bills with higher health care and food costs.
Ken, thanks so much for joining the show today.
Thank you.